So welcome to the TAN Education meeting for January. And we have a panel of three wonderful accounting and tax experts, Jonathan Kahn, Cathie Tardy, and Steve Stauss. And very conveniently for me, they're all in the top row of my gallery view. I don't know if that's working that way for the rest of you. And we have three questions that were put out in the announcement. And each of our experts is going to address one of those questions, and they will put their own particular twist on their interpretation of that question. And then there will be, the others can add or, just make additional thoughts, and then we will have questions among the group. Before we get started, I want to remind everyone, if you haven't already, please put your name, your email address, your phone number, and if you want some kind of identification as to what your role in the world is, like your job title or your business name. And without further ado, I will introduce Steve Stauss. He's going to start us off with the benefits of being an LLC or S Corp.
Well, oops, let me share my screen here. Right. Thank you, Anne. As the question was originally presented, it was a matter of trade-offs between S Corp and LLCs, and I wanted to say right from the get-go that that's a false dichotomy. It's not either S Corp or LLC. And I think the best way to explain that is to talk about what an LLC is. And coincidentally, I gave a short presentation to the State Society of Enrolled Agents back in July, and for that reason have a little bit of a handout prepared. And if it's okay with you, I'll just kind of speak from that handout. You can see my notes as I talk. Presumably, there we go. Okay. And this is, I'd like to kind of quickly cover some of these subjects. I don't have a whole hour. I have about 10 minutes today, so it'll be a fairly rushed presentation. But the key thing is, what is an LLC? The letters stand for limited liability company, not corporation. Sometimes you will hear people say limited liability corporation. It's not a corporation. And it is an entity that's organized at the state level. It's a business entity that you register in most cases with the Secretary of State of the state in which you wish to operate. And there's an established procedure that's set up in statute. It's parallel to incorporating. So if you want to become a corporation, an INC or an LTD or something like that, then you file with the Secretary of State making that declaration. And whereas there is statutory language that tells you how to file your taxes by default if you're a corporation, there is no corresponding statutory language that the IRS can refer to for saying that, well, LLC is taxed as X. So what the IRS has done is to set up some defaulting that basically says that if you're a single member LLC, you can file if you don't make any specific declaration on your Schedule C as a sole proprietor, effectively. If you are a multi-member LLC, then you file as a partnership. Notice that I didn't say anything about an S Corp. The default, if you're a multi-member, is partnership. So you have the option to elect how it is you want to be taxed. And I will tell you a little bit about that, and we don't have time to go through the process, but you can elect to be taxed as an S corporation or as a C corporation, or you can simply, accept your default taxation of sole proprietor or partnership. LLCs in some instances require you to make annual filings. In the state of New Mexico, we don't have to do that. So that's one of the advantages in the state of New Mexico to filing or to be, operating as an LLC, is you don't have to do the annual or biannual filings that so many of my clients forget to do when they are corporations and they get hit with a penalty. So that's an advantage to being an LLC in New Mexico. All right, let's just move forward here. What you file with the Secretary of State is what they call articles of organization, not articles of incorporation, which a corporation would file, but articles of organization. And the LLC has to have a unique name. The Secretary of State will require you to do a name search. And if you have a name that's too similar to another name, they won't let you use it. And that makes sense. Now, LLC has members. Corporations will have shareholders. And it's basically is a difference in nomenclature. But think in terms of the people who own an interest in the LLC as being members of that LLC. You can have one member or you can have two or more members. Now, I said earlier that there are defaulted tax choices. If there's only one member, by default, you are a sole proprietor. You file on your Schedule C. If you're two or more members, you're a partnership. Now, you can make an election, but you can't elect to be taxed as a partnership if you're only one member, because that contradicts the definition of a partnership, which is two or more people in business together. LLCs can have an unlimited number of members. They can include individuals, corporations, other LLCs, or even foreign entities. Okay. This is going to be, when Kelly Ann makes it available, it will be for your reference only, a lot of statute references and so forth. Now, in the state of New Mexico, forming an LLC is a fairly easy matter. You can do it online. In fact, they want you to do it online. It maybe will take you 10 or 15 minutes, fill out a couple of pages on the website, and then you're done. You do have to have a registered agent to form the LLC. And one thing I learned fairly recently, and I would invite Cathie to jump in if she has any thoughts about this, but I learned recently that in New Mexico, you can form an anonymous LLC, which means you cannot disclose, you can shield the members of the LLC and only publicly disclose the registered agent. The registered agent, of course, have that information. Cathie, have you had any experience with people wanting to form anonymous LLCs in New Mexico? Oh, you got to unmute.
I was going to say, no, not in New Mexico. I was recently on a call where they were talking about stacking the LLCs, and so some of them were anonymous. So yeah. I think it's, for more sophisticated tax planning opportunities. So.
Or if I will relate that I have a relative through marriage in Buenos Aires who wanted, on behalf of one of his clients, to form an anonymous LLC, and quite frankly, it had to do with sheltering dollars in the U.S. And so that we have to make decisions about whether we feel comfortable with the ethics of that or either the legal risk of doing that. But I suppose that is also another historical reason for having anonymous LLCs is that you have some anonymity from the government.
Well, and
Anyway.
also, yeah, I was going to say another reason you might want that is for asset protection planning.
Good point.
So if you, yeah, are trying to segregate assets because maybe you're a target for some reason, that might be another reason you'd want that anonymous LLC filing.
Very good. Thank you. That's a very good point.
If someone tries to sue your LLC, can they find out who the members are of your anonymous LLC?
Well, I suspect it would require court action because the state would know the name of the registered agent. And I don't know the legality of whether the registered agent would be, what it would take to force the registered agent to disclose that. This is a legal question. Do we have any attorneys here on the call? Yeah. So I don't know, Steve. One thing that I want to say, if you do form an LLC and it's not with your spouse, and even if it is with your spouse, you might want to seriously consider having an operating agreement. And probably the most important reason is to describe how you're going to dissolve when you need to dissolve because you've gotten into a fight, you can't resolve it, or you just want to close the business down. And the operating agreement will specify all the rules around dissolution. It will, of course, it should specify the rules around sharing in profits and expenses, expense deductions, and other just general, who the manager is and that sort of thing. So I, as a tax person who's not an attorney, I'm not qualified to write operating agreements. I have attorneys I work with, I refer people to. So if you are thinking of forming an LLC that involves other members, seriously think about having an operating agreement. Electing to be taxed, let's circle back to the S Corp. You want to be taxed as an S corporation. There's a form 2553 that we typically use to make that election. And there are provisions that allow you to make a late election. There is a RevProc down here, the third major bullet, RevProc 2013-30. RevProc stands for Revenue Procedure. It's a document published by the IRS. And the Revenue Procedure allows you to claim that you intended to make the election at an earlier date. You just didn't, for administrative or other reasons, did not complete the paperwork in a timely manner. Now that's kind of a little bit of a wink, wink, nod, nod. The IRS, just cuts us a little bit of slack on that. I think that's just the best way to think of that. Now, if it goes back several years, and I have had personal experience with this a number of years ago, where I attempted to make that late election for a client who had not been acting like an S Corp. This is the other half of this late election thing. If you filed your 1120Ss, the S Corp tax returns, without having made the election, and you go back a couple of years, then you should normally that election should be accepted. But if, on the other hand, you had been filing as a sole proprietor, and then you go back a couple of years, say, well, I really meant to be an S Corp, and they look back and say, well, you didn't file your S Corp return, they will turn you down, most likely. And I don't know, Kathy, if you have any thoughts you want to add to that.
Yeah, I've actually used the late election a couple times now, primarily with individuals who start their own business and they don't really have any professional advisors. And they are an LLC, but they start doing payroll. Yeah. So they've sort of made themselves an S Corp by default. So you kind of have the decision, do you try to get a late S election through, or do you unwind the payroll that they've been giving themselves
Yeah.
Because as just a straight up sole proprietor or partnership, you're not entitled to get paychecks. You get other types of funding, but not paychecks. So I have used it a couple times successfully for that.
Mm-hmm. Yeah, that's, well, you know, we don't want to jump on John's boat here, but that is a very important point that Cathie makes about if you're a sole proprietor, you don't write yourself paychecks. I mean, you take draws or distributions, whatever you want to call it. You take money out, but you don't provide yourself with a W-2 and so forth. And that's true for partnerships. And the partnership point is an interesting one because it's only been in the last few years that the IRS has really made taken a strong position on that and clarified that partners are not employees. I mean, you can get a guaranteed payment, which is different from a paycheck, but it's called a guaranteed payment and it's reported differently. I think I probably have talked a little too long here. Yeah, are there any questions? I mean, this is the link here if you want to set up your LLC on your own. I would advise that you call Cathie or me or somebody, you know, if you want to do that, or hire an attorney. But I have a lot of do-it-yourselfers in my book of business, and sometimes I have to unwind what they did to themselves, for themselves, and to themselves. So that's it from, you know, as far as presentation goes. Happy to, you know, answer any questions you might have. You guys are all reading the news, it looks like.
Hey, Ann, you're muted.
I clicked on it and it didn't do anything. So I thank you so much, Steve, for this presentation. It's a lot of this topic is very in depth, and so we might want to invite you back just to give an education meeting on this topic alone. And
Sure.
I'm guessing that people will have more questions once they are able to look at the handout that you have. And I will email it to everyone. I did try to figure out how to put it in the chat and I was not very successful. So I will send it out with the list of everybody that attended today so everybody will get Steve's handout. Any questions right now before we move on to John? Okay, the floor is yours, Mr. Kahn.
Wonderful, thank you. Thanks, Steve. That was very concise. So I don't have a presentation for the screen, so you just have to look at me. Sorry about that. By the way, Kelly Stanhope, I love the background that you have. Still in the Christmas spirit. So my topic is payroll and things you might consider with payroll. And so that's kind of a loaded question or maybe a moving target, whichever one of those you like better. But since there are so many different things that you have to consider just administering payroll, the easy answer is to form an LLC and just not worry about it. But when you do have employees, you have payroll. And so because there are so many things that you have to consider, my first tip for you is to not do it yourself. So lots of people do payroll themselves. And even when you have a program like QuickBooks Payroll that's helping you out with it, if you make mistakes, those can get out of hand very quickly. And especially in QuickBooks Payroll module, what you end up having is a mistake that can cascade and get worse and worse with every passing pay period. So my tip is to get some assistance. Payroll assistance is available through QuickBooks. You can get different tiers of assistance. including all the way up to full service payroll. It's not cheap, but it is cheaper than the IRS penalties. So I would highly recommend that. You can also have someone like me or Estella assist you with payroll, because we are both experienced dealing with QuickBooks payroll. A third option that can be a good one is outsourcing it. The advantages of an outsourced payroll, of course, the obvious one is that it's done for you. Some other not obvious ones are that difficult things like ACA reporting aren't a concern. Tax returns and payments are made on time. And my favorite one, the liability for missing a tax payment or being late with it is not yours. If your tax payment is late, your outsourced payroll company is responsible for that penalty. There are disadvantages. It can be expensive. It's usually not as expensive as the IRS penalties are. And you run a very tiny chance of having somebody steal your money. I don't know if any of you remember the story from last year with My Payroll HR. One of the guys at the top stole $35 million, and it was all employers' money. So one of the ways that you can protect against that is to find a payroll outsource company that does not impound your money. Although that's going to be very difficult, because I knew one here in Rio Rancho, and he recently sold his company to a much larger payroll company that does impound your money. So that's something to keep your eye on. The other way, of course, is that if they impound your money and then steal it, you're still responsible for it. So,
Jonathan, what does impounding my money mean?
So one example is, say you're a small employer that only has to pay your payroll taxes once a month, but you have payroll every 2 weeks. So if you have 2 payrolls this month, your taxes are not due until the 15th of next month. But impounding your money means they take everything that's due right now and they put it in their account.
Oh, okay.
So normally that's not a problem, because they take it and then they send it to the IRS. They make a little bit of interest on the float. Nobody really begrudges them that, but there have been a few instances where somebody just took all that money and ran with it before it was sent to the IRS.
Mm-hmm.
So in that case, just
Thanks.
make sure that you have, oh, no problem. Thanks for the question. In that case, you are still responsible. The IRS doesn't care that somebody stole your payroll money. So if that does happen to you, understand that you need to pay the IRS to avoid the penalties. So kind of coming back to more general types of things.
John, before you switch subjects,
Sure.
did you want to mention that the IRS has what they call the trust fund penalty if the payroll taxes are not remitted of 100% of the taxes that were owed potentially?
Oh, right.
And the owner and the bookkeeper. So, you are potentially liable if you, well, what happens sometimes with small businesses is that they are a little cash short and they delay remitting the payroll taxes, and they get behinder and behinder. And if they may end up a year or two behind, the IRS catches up with them, and we'll be talking about 10 or 20 or $50,000 in taxes that they are personally responsible as the business owner, and that can be collected from them personally.
Right. And that's a great point. I was going to mention something about that near the end, but it's actually better here.
Sorry.
No, that's fine. It's better here. Yeah, it's mine was more of a general kind of a comment. And that comment is, don't get behind on your payroll taxes. It's very, very easy to dig that hole, and it's very, very, very hard climb back out of it. So yeah, the more general thing I was going to say is that there are lots of different options for you if you choose to outsource your payroll. Just off the top of my head, there's Gusto, ADP, Paychex, and Paylocity. I can recommend Gusto and Paylocity. I don't know anything about ADP. Stay away from Paychex. I hope nobody on this call works for them. And then of course there's QuickBooks. QuickBooks is something I know how to handle. If you're going to go with QuickBooks, I recommend, again, call me or call Estella, because QuickBooks, in QuickBooks, the payroll module is very, very picky. And if you don't do everything just right, it can throw errors at you and cause all sorts of problems. So then one of the other major things to think about with payroll is the difference between a W-2 employee and a 1099 contractor. And that is, it's a kind of a sticky one. There are rules about who's an employee and who's really a contractor. But basically what it boils down to is how much control do you have over the person working for you? Do you tell them when and where to be at work? If so, they're an employee. Do you provide their tools, equipment, other supplies? If so, they're employees. And I can use myself as an example because earlier in 2020, I had a part-time job and I worked for myself the other half of the time. And at my part-time job where I was a W-2 employee, I was given an office with a desk and a computer and some filing cabinets. And I was told to be at work from a specific time to a specific time on specific days. That made me an employee. The other half of the time, which is now 100% of my time, I maintain my own office. I buy my own office supplies. I buy my own equipment. And I tell my clients when I'm going to work. That makes me a 1099 contractor. The state comes down pretty heavily on the side of making you an employee. So that, because they like collecting state unemployment taxes. And there are ways of proving that somebody is not an employee, but that's getting very specific. And so if you are in a position where you're wondering, you should probably call us, call Steve, call me, call Cathie after this is done. And well, I think that's about it. Now I'm back down to the point that I was going to make that Steve made more eloquently. Don't get behind on your payroll taxes. And of course, like I said, there are many, many moving parts within payroll. So if anybody has any general questions, we can try and address those now.
Steve Kind, you had one?
So I understood that many people who tried to use a sub-S filing, whether LLC or regular sub-S, the reason they did it was to try to have some of their income taxed at a lower rate, not subject to payroll tax, called a dividend, as opposed to salary. Could you go over the rules of how that works?
John, do you want to address that, or should I?
I think you're better suited for that question, Steve.
That's a very good point, Steve, and I had it in mind to mention. And I think the easiest comparison to understand is if you're a sole proprietor, you get taxed on 100% of your net profits, and you get taxed both income tax and payroll tax, or self-employment SE tax. And yes, that's up to the threshold of what, 137,000 or whatever it is now. But if you're an S Corp, you can do a little bit of balancing here, because as an S Corp owner hyphen employee, you are both an investor and an employee. So you're allowed a return on your investment, which would come to you in the form of a dividend, if you will, or a share of profits. And as an employee, you're going to get paid a salary, and the IRS expects you to have a reasonable salary, so that, let's say hypothetically, before you pay yourself, you've got $100,000 in profit. You could say, all right, I'm going to pay myself $50,000 salary, and then the other 50,000 is just going to come to me as profits and is only be subject to income tax. The first 50,000 is also subject to income tax, but additionally is subject to payroll tax. So, and as the S Corp owner, you're going to pay both sides of the payroll tax. You know, the tax, your share of the, of your wage, plus the employer match. So 15.3%.
Is the dividend itself taxed at a different rate than the
It's going to
salary?
be just taxed at your income tax rate.
Not a different rate for dividends.
No. It's ordinary income.
So who determines of that 100,000? What, I'm 74 years old and I've been receiving Social Security, and so to me, to be paying payroll taxes doesn't do me any good. It will never do me any good.
Yeah, small.
So who determines how much of that 100,000 can be considered salary and how much can be considered dividend?
That's a very good question, and I'd like to say there's a clear-cut answer, but there's no really bright line answer. But what the IRS can do is look at what is the work you're doing, and what does the typical employee in your salary area, your salary geography, get paid for doing that work. And then of course there's the question, is it half-time, part-time, third-time, whatever. And ultimately, if you get audited, you're going to have to be able to defend based on what the market salary is for your kind of work and the amount of time you're putting in, what you should be paying yourself salary-wise, and then the balance can be, dividend. I sort of moderate that a little bit, Steve. Like if somebody is only netting 50,000, and what they're doing would normally be paying 60,000, obviously they're not going to pay themselves 60,000. They don't have the money available, the cash available. I kind of use a metric, and I'd be interested in hearing what Cathie has, and other people think about this, of saying maybe 50%, you've got 60,000 to work with. Well, pay yourself a $30,000 salary and take the other half in investors' return.
So my question becomes also, not just do you have to justify the salary amount, but also do you have to justify the dividend as being a return on investment? And if there's a very small investment, as there might be in being a salesperson, not having much in the way of plant and equipment, how can I say that this significant amount of money came to me in a dividend as a return on investment?
Well, ultimately, it's an S Corp is a pass-through entity. The profits get reported on your 1040, and it gets combined with all the rest of your income, and you get taxed on that. Now, in terms of using the return on an investment argument for justifying that, well, I took half of it as just profits, I don't know that there is an argument that, I haven't seen an argument. Cathie, I'd like to hear what you say. I think the strongest argument that the IRS looks at is what's a reasonable salary for the work you're doing. And then whatever all the rest is just profit. Doesn't matter if you invested 1,000 or 100,000. There's no formula that they apply that says, well, you should be making 15% on your investment. It's just whatever your profit is.
So the other problem as a salesperson is, what's a reasonable salary for a salesperson? If I'm a real unsuccessful salesperson, then a reasonable salary is very low. If I'm highly successful, it's very high.
I know. That's perfectly good point, and that's why I say there's no bright line. You have to be prepared to argue that. I would say that if you're very successful, lucky you, and if you're, I would say you could reasonably point to, well, I don't want to use the word reasonably. You could certainly try to point to you know, the typical realtor in my niche makes $75,000 a year. That's what I'm gonna pay myself. And the burden is, you know, to some degree on the IRS to prove that, well, you should be paying yourself more. Kathy, I'd like to hear what you think.
Yeah, I have a couple thoughts about this topic because it's really something the IRS is really focused on, because they did a study and they found out that the average wage on all S Corps that people were reporting on their W-2s was like $20,000. And so we're talking about, you know, small businesses to multi-million dollar businesses. So they see it as an audit target. And I was actually told by someone who used to work for the IRS that they look at several numbers on your tax return. There's a line that says compensation. And then on your K1, there's also a number that's called distributions. And this was the dividend that Steve was referring to. And so they kind of do a matchup there. Now, if you're getting a $20,000 W-2 and a $200,000 distribution on your K1, you're going to be getting the audit notice. So, you know, CPAs and other tax professionals have been, you know, worried about this particular situation for a number of years. And there's actually companies now that will conduct reasonable compensation studies. And now those will take into the factors that Steve was mentioning, like someone in your geographic market that does similar work to you. What do they get paid? You know, how successful are you? But another issue that just came out in another class that I attended was, do you have any other employees? Because IRS wants to say anything that's distributed out of the company should be on your W-2. So very little should come out as a distribution if you don't have any employees. So that's something, there's been a number of court cases this past year. And so that's something that we're really looking at.
Yeah,
Why-
I think
Yeah,
don't
why is it
push the
saying that
limits.
if you don't have
Yeah,
one
there was-
with employees?
I was just going to cite an example. I can't remember 2005 or 7, Kathy, maybe you remember. It was a court case that the taxpayer lost. It was, interestingly enough, an accountant who was pulling about $200,000 out of his business and paying himself a $24,000 a year salary. IRS didn't think that was enough, and they won. The IRS won. So
Yeah, and IRS has been winning, and that's
Yeah.
my concern.
Yeah.
So it must be reasonable. And I understand, I've had other clients say, well, but I'm getting Social Security. Why do I have to pay in? It's not going to change anything for me. But IRS says if you're an S Corp, you get a salary. So, and it must be reasonable. So you don't really have any options there. And
Okay,
then
what do you
that
think
kind of
about
gets
that
back
50?
to Steve's point of LLC versus S Corp. So they all have issues, and you need to be thinking about them, you know, before you make those elections.
But you can have an LLC that is an S Corp.
Correct.
Oh, yes. You can also have an Inc. that's an S Corp. So you can
Right.
incorporate and report and elect to be taxed as an S Corp.
But that's pretty restrictive in many ways, isn't it? An S Corp.
You know, it depends. You really, anymore, we've been looking at choice of entity for clients, and sometimes we say, go C Corp, because they maybe don't have any other employees and they want to really max out their employee benefits. You know, maybe S Corp works because we do have some flexibility. Maybe we have a couple of employees so we can pay more out in distributions. I mean, it's really very specific to the entity and what you're trying to accomplish, you know, long-term goals for the business. So I think they're all equally good choices of entity, but you need to decide which one works best for you.
I will throw out, a couple of years ago, I was working with a person, who was specializing in the marijuana industry. And that was a special tax problem because, it's not, marijuana is not legal at the federal level, banking issues. And the attorney she was working with was advising clients to pick to incorporate rather than, and to report as a C Corp, to provide a thicker wall of protection around the entity, and while separating them from their personal assets. Because with an S Corp, an LLC and an S Corp, you are a pass-through entity. Partnership, you're a pass-through entity. And there was the feeling from a legal standpoint that there was a thinner veil, of protection. So I don't know if any of you are thinking about getting into the marijuana business. I think that there's probably a pretty good chance that this year it'll pass the legislature, and recreational marijuana will. Of course, the medical marijuana has been legal in New Mexico for a number of years. But that's another consideration, how thick is the veil separating your personal assets from your business activities?
Hey, Steve, could you put the name and phone number of the marijuana person in the chat for us? I'm just teasing. It's a drug joke.
Oh, okay. Oh, yeah. You want? Well, I can hook you up.
Hugs looking for
Let's
a
talk
hookup.
after the call.
It's a bad drug joke. Sorry.
For Steve and Kathy, have you noticed a trend in the percentage of your clients who are getting audited continuing to decrease as time goes on? It seems that's what is being reported in the press. I just wondered if that is a reality.
Well, knock on wood, I haven't had too many of my clients audited. Makes me nervous, makes them really nervous. But they are reporting that, especially now with COVID and the lack of on-site visits and things, that audits are decreasing. But like I say, they have this target for S Corps. So, if you are sort of a easy target, nothing's in your wage box and your distributions are huge, you're going to get the letter. So I think they're being more targeted in how they select people for audit. And so if you are being reasonable and you have a basis for doing what you're doing, you're going to be a lot better protected and less likely to get an audit notice. And sometimes too, even on maybe something that's a little grayer, we may attach some additional documentation to a tax return to kind of give the IRS a little bit more information so they know why this seems a little bit different from what they would expect. And we hope that some of that disclosure will discourage, getting those IRS notices. So.
Would you also expect that home office red flag is going to be decreasing quite a bit as time goes on and more people file as a home office?
Yeah, I think it may be a target though, because there's a lot of misunderstanding in home offices right now, because when they changed the tax law a couple of years ago and took away home offices for employees, I think with COVID, we have a lot of employees working from home, and I think we're going to see them trying to file home offices, which they're not entitled to with that tax law change. Yeah. So there are safe harbors for people who actually do qualify, a certain dollar amount per square foot that you can just take the safe harbor and not worry about it. But I don't usually recommend that for clients that actually have home offices, because I find that they're really spending more than the safe harbor amount. So to really qualify, then we ought to do the actual expenses.
Right. The safe harbor is capped at 1,500. It's $5 a square foot up to 300 square feet. So you may well have much higher expenses than that for your home office.
I do. I don't. Yeah. I itemize my home office.
Yeah. In terms of audits, Steve, I In my, what, 11 or so years, let's see, I've had a couple of audits that have come to me already in the audit process. But what I have seen a pretty substantial increase is what the IRS calls letter audits, or notices, where they're sending all sorts of letters out. Their computers are generating them because it doesn't take any human labor except for stuffing the envelopes, I suppose. And you owe $89.37, or or sometimes it cuts the other direction. I don't know, Kathy, are you seeing a lot of letters coming from the IRS these days?
Yeah, a lot of the automated letters, and
Yeah.
and it's really frustrating because the IRS employees are also working from home.
Yeah.
And they had a huge stack of unopened mail before COVID hit, and now it's even worse. So trying to get them on the phone, you'll spend 3 hours on hold. And if you send something in the mail, you don't even know when they'll open it. So it's a little frustrating dealing with IRS right now.
Very much so.
So with that, Kathy, we'd like to transition into your actual talk, but it seems to me that you've actually started to really cover a lot of things you probably would have covered in your talk. And I also, before you do that, there are at least 2 people in our group that have not put their name and contact info in the chat. So I am being the contact info police and asking you to do that. And without further ado, thank you, Kathy.
Okay, well, like Jonathan, I do not have a presentation. I appreciate Steve going to the trouble to do that. I was supposed to talk about top things to consider for your business taxes. And that's such a huge sort of topic that I tried to, I think, narrow it down to things that are maybe time relevant. And so I guess one of the first things that I wanted to mention is be kind to your tax preparer this tax season. Because if you thought 2019 tax filing season was awful and you couldn't talk to your tax person, my cat's trying to get in on the action here. You couldn't talk to your tax person and they were so slow and they would never get back to you. Well, I think we're coming into another year like that. I was just on another webinar, and besides the tax bill that got signed into law on December 27th, just last night we got 2 IFRs from the SBA, which the IRS has agreed to, but they're dealing with all the new second round PPP information. So I just wanted to say, be kind to your tax preparer this tax season. And so one of the other things that keeps coming up is because all of these rules and regulations and interpretations are coming out, and like I say, they're just coming out. 2 of them came out last night. We're trying to digest what all that information is and try to get it out to our clients. But some of it may indicate actually that it may be wise to extend your return and file later because we're still figuring it all out. So I've already had conversations with some of my clients about that very thing because, and anyone who has a PPP loan knows that if you already filed for forgiveness, you maybe have had to go do a lot more work than some of the recent rules where now if you have a PPP loan under 150,000, you basically sign your name and certify you needed it and you're done and you're home free. No sending in of payroll reports, no, running through these complicated spreadsheets. So it may be wise to keep abreast of what's happening out there to see if something is going to impact your particular situation and it makes sense to maybe extend, because business returns are due March 15th, which is basically 2 months away, and we're just still learning. And we have another round of PPP that the applications are supposed to open up January 11th. That's the soonest. Now, there are some special groups, so people who maybe hadn't applied for PPP before, and also maybe some disadvantaged groups may get earlier application opportunities. So they're saying the 11th through the 14th. But so anybody who is looking at getting a PPP, or maybe asking for a larger PPP than they already had gotten, that's going to be another thing that distracts your tax person if they're helping their business clients with the PPPs. So just kind of be aware of that. And I know that a number of us send out information to our clients and our contacts about what's happening with PPP. And I know Craig Dill has been very diligent about sending out a lot of the information. So be looking for that, because like I said, it's happening very quickly. The actual application has not been made available yet, but be looking for that, pay attention. One of the things that we found out late December was the PPP expenses that we were told by IRS we could not deduct, yay, are now deductible. So we were hoping that that would finally come through in the legislation, and it did. So they were saying initially, well, the income is not taxable, which is fine, but then they were saying, but you can't deduct anything that you used to spend the money on. So essentially you end up getting taxed on it. So now this deductibility, which IRS has agreed to, is available. So your PPP money is not taxable, and your if you got an EIDL grant, which was the $1,000 or so, depending on employees, that came in as a grant, that also is not going to be taxable, and it will not reduce your PPP deductibility. So you will not have to pay that back, which was another thing that was people were worried about because that's what they were saying. So just be aware of that. What else did I want to say? Actually, one of the things that Ann asked me to kind of speak about too was like, well, how do you get ready to do your taxes and bring in things to your preparer? And so obviously no one loves the shoebox. And guess what? We have scanners and we have phones to take pictures. And I know our office is really happy when we get all of your documents electronically. So I think most preparers would be the same. So think about how to make it easier for your preparer to give you organized and complete return. So electronic documents as opposed to shoe boxes are always much better. I think too that when you're coming into talking to your preparer, that you should have your list of questions ready. You should know things you're concerned about and present those to your preparer, and you're going to have a much more efficient and effective meeting with them. Hi, Scooter. So prepare your list of questions before you go into your meeting. And then something to really pay attention to, and I know people say, well, but you're the professional, I'm going to rely on you. Please, please, please always review your tax return before you sign it. Make sure anything that's unusual or different that happened this past year is reflected on the return, because sometimes what happens is you think somehow your preparer knew something that they did not know. So just please, please, please review it before you sign it and send it in. So in regards to what to bring for your business, please bring, besides your P&L, also your balance sheet. I don't know how many times, and you probably, a number of you have heard me kind of preach about this, but we need 2 documents to know we have a balancing set of books. And so this is where my little horror story comes in. So I was meeting with a new client, and I asked him to bring a copy of his past tax return as well as his financial statements that were for the same period of time. And by financial statements, I meant, yes, balance sheet and income statement. And so we started talking about the balance sheet. And he says, oh, yeah, I never look at this. I said, okay, but we need to look at this. And he says, no, I just look at the P&Ls. And so I know where I'm at. And I said, okay, well, but we need, because he actually is a C Corp. You're a C Corp, and we need to report that on your tax return. So we need to make sure the balance sheet is correct as well. So we started marching down the balance sheet. Is this your cash balance? This man had 4 cash accounts, and I'm just going to make up numbers, but like the first account was like a minus $2 million. The second account was like a plus $5 million. The third account was maybe $45,000, and the fourth account was another like minus $150,000. And so I said, okay, well, I understand you may have more than one bank account. So how much is in this bank account? Oh, I only have 3 bank accounts. And now I only have probably about $50,000 in the bank. So needless to say, an adjustment to cash is going to hit your P&L. And so even though for many years he'd been reviewing his P&L, his whole books were wrong. And as we marched through, okay, do you do physical inventory? Is this the correct number? Okay, what's your accounts receivable? Are these collectible? So as you're talking with your tax person, you can actually learn things that will help you manage your company better by talking about the items on your balance sheet. Your financial statements are a management tool, and so you'll be better able to manage your business if your tools are correct. And, I don't like it when my clients say, oh yeah, my bookkeeper gives them to me and I just put them in the drawer right there. I don't even really look at them. Makes me very nervous. I know that does not happen with Jonathan or Estella. That is not going to happen. There's going to be conversations and questions. But so bring in your balance sheet and your income statement, and let's make sure they make sense, because when we got done with this gentleman's financial statements, I believe we made a $200,000 adjustment to his retained earnings. So but the bad news was we couldn't prove what it was. So that was a $200,000 lost tax deduction. So think about that one. So that's another good thing to do, to be prepared when you go in for your meeting. And especially too, if you've been doing your books and you look at your balance sheet and you think, yeah, that doesn't really make sense. Here's the perfect opportunity to talk to someone who knows, and they can help you figure out what's going on. So please, balance sheet and income statement. We actually have 3 statements, cash flow statement, but nobody's using those yet, or very few people are.
Kathy, if I could interject,
yes.
I have had similar experiences. In fact, I had a client for 1 year and then I fired him this year because the bookkeeper was so uncooperative. But their cash basis, and she gave me all the reports and accrual, and we had a huge negative AR balances and things like it. Just the books did not comport at all with the tax return the previous accountant had prepared. So, and I think that it's real important. I mean, you see that when you see both the balance sheet and the income statement, you can see that things are out of whack. But the other thing that I often will get reports from, and please do pay attention to this if you do your own books and you use something like QuickBooks. If you're a cash basis tax return reporter, don't provide your tax person with accrual basis reports. I mean, the numbers can be completely out of whack. So anyway, give them what they need to do the tax return. Give us what we need to do the
So what I'm hearing is that as in the role that Jonathan, Cathie, and Steve have, that they do expect you to understand a little bit about your business, your financial accounting, and to be connected to with what's going on in your business. And yet they're also there to help you once you start to see the light that you don't know that and you need to know that. Thank you so much. Yes, Cathie, did you have
just
one
want to
more?
make one more point that I forgot to mention because I think this could be relevant for some of us, but also in the recent notices and rulings, they have said that the employer retention credit can be used even if you did take a PPP loan. So you may want to revisit that because I know a number of people said, oh yeah, you get the PPP, you can't have both. And that was true, but now that is not true. So in some circumstances, you can get both the employee retention credit and a PPP loan. So just keep that in the back of your mind.
Thank you, Cathie, for adding that. I think that's really important information for everybody to know. Are there any other questions before we conclude? Because we are 6 minutes past the half hour that we would have ended at. So, I'm sure our panel can stay here for a few more minutes if you have additional questions. Otherwise, we will wrap it up. Callie, you need to unmute.
So just really quickly, I wanted to let people know that the education meetings are going to be sets of panels like this. Priscilla and I have been working diligently to be able to kind of showcase more TAN experts. And we may also have some guest speakers at some of our education meetings, which we're very much looking forward to. But we will be doing some panel discussions with different topics going forward through the year. So Jonathan and Cathie and Steve, thank you so much for participating in this first one. I thought that was great. And you guys all have your own set of expertise and ways that you approach things, but your professionalism and what you brought to the table was just great. And we're looking forward to doing that with a couple different panels. Is there anything you wanted to add to that, Priscilla, before we all sign off? No? Okay. Thank you, everybody.
Thank you all
thank
for
you,
attending.
everybody.
Happy New Year.
Happy New Year.
Happy New Year.
Happy New Year. Bye.
Bye-bye.
Bye, everyone.
Bye.